So we experienced a really volatile week in the stock market a week ago. The S&P 500 was losing over 1% each day from Monday through Wednesday. Then Thursday, it closed flat after being down big time. And then Friday, the Dow Jones went up 370 points before collapsing in the afternoon. This is the third consecutive week of losses, and things appear to be getting worse. It's reasonable that individuals are concerned when they check into their investment accounts and realize that their portfolios are plummeting. After all, your investment portfolio seems to be your future if you aren't already living off your investments. If you're currently living off your investments, your portfolio is generally your life. However, if you've slowly built positions in companies, ETFs, and closed-end funds with the hopes that one day you'll either rely on your portfolio for your financial needs or live entirely off your investments. It's a big deal in your life, and what we've gone through is clearly troubling for us. As we enter this challenging season, I decided to make this video to educate, or perhaps for the first-timers, to enlighten you about the most important fundamentals of investing in the stock market. It is critical that if the markets continue to collapse in the next months, you should not panic sell and liquidate all of your investments until you believe the market will rebound. Panic selling may harm your portfolio and your future. It's essential that we discuss this since we've been in a bull market for a very long period of time. And for a particular number of my viewers, particularly those under the age of 30, this is most likely your first experience investing over a bear market. Times were very great, beginning in late 2009, and in spite of the recent plunge, this ongoing market downturn that's been happening for months is an entirely new experience for many individuals. Or perhaps you are old enough to recall the 2008 financial crisis and weren't an active investor back then, but you are now. So for those folks as well as millennials and Generation Zs, this is a completely new market. What you're now looking at is the history of the Dow Jones Index for the previous century. We can witness some of the greatest declines that have ever been recorded, such as the 1929 market crash and the 2008 financial crisis. However, it is vital to remember that the market has always rebounded and soared higher following these market downturns. This certainly varies from year to year, with some years being down and others being up. It has been this way for almost a century, so what we're dealing through will eventually come to an end. When it will end, I'm not sure, and no one knows for sure. That everyone, CNBC, Fox Business, and other news outlets can only presume about when the market will bottom out. Many people believe that the market would bottom out in June, but it looks that this may not be the case if things continue to fall as drastically as they have. But regardless, if you are not dollar cost averaging with your investments, you must be. Let me know in the comments if you have any other questions about investing. Let's return to the video. Dollar cost averaging is the best practice of investing money at the same time, despite how the market is performing. It might be $50 once a week or $300 monthly, but studies have proven that this is the greatest investment strategy when compared to trying to time the market. In times like these, I'm delighted that Apple prioritizes dividend and income investment above growth investing. Since at times like this, I don't care about share prices more than I do about dividend payouts. In fact, if you are going to face a longer period of flatlining stock prices, as we did beginning in the mid-1960s, dividends will account for the most of your returns. If stock prices aren't regularly rising, selling shares isn't likely to make you any money. In these market situations, dividends will indeed benefit you. I'm not saying we'll have a long period of flatlining stock prices, but this is what some individuals are speculating. However, I don't invest in growth stocks, but instead try to figure out when the company's growth is over and I'll need to sell my shares and put them somewhere else. Consider the Roblox stock as an example. It's a very popular stock among the growth investing community, with many praising it as the best thing since sliced bread. Kathy Wood owns a large portion of it through her Art Growth ETF and has been a long-time supporter of it. Roblox stock is down nearly half since its creation, but if this stock does increase and become enormous, which it very well may, you must try to predict when the stock will cease rising. Growth investors must constantly analyze their portfolios to determine when to sell all of their shares and look for the next big stock that will not be a flop. However, as a dividend investor, I look forward more to red days given that they are my favorite days in the market, since they signal that my favorite dividend and income stocks will give me more passive income for every dollar I spend on red days. If I had $1,000 to invest and a dividend stock I like was $10 per share yesterday, but is now $9 per share, that's excellent, since it means I can buy more shares for the same price and so receive a greater dividend payment. And I always make absolutely sure to reinvest my dividends unless I believe one of my dividend stocks is now overvalued. Whether things become better or worse in the coming days and weeks, they will eventually get better, and we will overcome the storm like we have in the past. Markets usually rebound and eventually continue to expand to become larger and better than they have ever been. But until then, some basic guidelines for every recession are don't panic sell and lose out on portfolio gains. Live well below your means and have a sufficient emergency fund if you don't have one yet. As the Fed raises interest rates, I'd suggest opening a savings account with a bank that gives a high interest rate. Banks should be paying you a better savings yield on your money. I've utilized Ally Bank for my emergency fund, which presently gives a 2% return on all account balances, which is a lot better than a number of dividend stocks out there such as Sherwin-Williams and Avid Laboratories. And as interest rates continue to rise, I expect this 2% yield to rise as well. I'm not affiliated or sponsored by Ally Bank in any way. I've just been a client for many years. If you don't like Ally, there are many other banks that provide the same interest. However, it's a great deal better than earning at Chase or Wells Fargo. You may earn 1% interest. Well, that's all I had to say about it. I know it's not easy, but just stick in there and don't sell your stocks in a panic. If you panic sell, you will be unable to re-enter the market at the appropriate time, and you will miss out on significant up gains during the rebound. And I'm not saying never sell an investment if you're invested in a bad company or if you seek a tax write-off. Now is a wonderful time to do so. But other than that, don't accept the losses and just hold on there. Just stay calm. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.